We are unraveling this exact financial paradox with Aston Martin today. We are not really looking at whether people actually want to buy these cars because they clearly do. The demand is absolutely there.
Yeah, there's no question about the demand.
Right. What we are examining is how a balance sheet can be so structurally compressed that the clock is running out before that obvious product success can actually turn into spendable cash in the bank.
Exactly.
We are looking at a company where survival is essentially a month-to-month calculation, despite selling one of the most recognizable luxury items on the planet.
And to really grasp how this happens, we have to distinguish between two concepts that are very easily and very often honestly confused in business.
Okay, what are they?
Improving business performance versus improving financial resilience.
Ah, right.
Because you can have the former without the latter.
Yeah.
And Aston Martin is just a textbook example of having the former. The performance of the business itself, the revenue growth, the gross margins per vehicle, all of that is absolutely moving in the right direction.
But they lack the resilience.
They desperately lack the financial resilience. Their balance sheet is wound so incredibly tight that it leaves, almost zero margin for error in the physical world.
Which brings us to the £117 million question. Right. How does a company with improving margins end up burning through £117 million of free cash in a single quarter?
That sounds impossible.
It does. And to understand a cash drain that massive, you really have to look at the physical, gritty reality of building a luxury car.
Yeah.
It is not like software where you write the code once and sell it 1,000,000 times with zero overhead.
No, not at all. Manufacturing hypercars means trapping your capital in physical objects.
Right. Think about it like this. It's almost like flipping a massive, really expensive real estate property.
Oh, that's a good way to put it.
Yeah, you pour immense amounts of money into it up front, but all your actual cash is trapped in, like the drywall, the copper wiring, the building permits.
Yes.
In this case, it is trapped in the carbon fiber chassis. It is trapped in the hand-stitched imported leather, the titanium exhausts, the custom V8 engine block.
Exactly. You are technically building an asset of immense value, but you cannot pay your factory's electric bill with a V8 engine block.
Right.
All your cash is locked in that physical inventory until the exact moment the buyer signs the paperwork, takes delivery, and finally hands over the check.
So that physical constraint is what drove the cash burn.
That is exactly it.
Right.
That £117 million outflow wasn't just management throwing money into a furnace or, losing it on bad investments.
Right. It wasn't just wasted.
No. A huge chunk of it was exactly what you just described, inventory buildup. Specifically, their inventory on the books increased by £42 million in just 3 months.
Wow. 42 million just sitting there.
Yep. They were ramping up production for the new DB12S and preparing the factory line for deliveries of the Valhalla. And on top of that physical inventory, their receivables, which is, money owed to them by dealers or customers that just hasn't hit the bank account yet, that rose by another £14 million.
Because building a vehicle at this level of craftsmanship is notoriously lumpy, right? Like it's an uneven process. The cash doesn't just flow in a smooth, predictable line.
Far from it. A single car sitting on the factory floor being assembled over several weeks is a massive cash trap. It is pure outflow.
Right.
You are paying the suppliers for the brakes, you're paying the assembly workers their wages, you're paying for the factory overhead, all while that car just sits there generating absolutely nothing.
But the moment that completed vehicle rolls off the line and is delivered?
Boom. It releases a massive wave of cash that was trapped just a few days prior.
Okay, that makes sense.
And because we are talking about a relatively small volume of extremely high-value items, a batch of just 20 or 30 deliveries slipping from, say, the last week of March into the first week of April that can swing the entire quarter's revenue, profit, and working capital wildly.
Which explains why a single quarter's £117 million cash drain isn't automatically a countdown to immediate bankruptcy. The money is coming, it's just, tied up in carbon fiber and leather. But even knowing that, it is exactly why management is hitting the panic button right now, because they finished March with just £178 million in cash on hand.
Which is not a lot for a company of this size.
Not at all. And the only reason they even bumped that figure up to roughly £230 million was by pulling emergency levers.
Right.
They sold their Formula One naming rights for £50 million, and they took a £50 million shareholder loan from Lawrence Stroll's U-Tree consortium.
Yes. And consider what that actually means operationally. They supported their baseline liquidity through one-off asset sale, asset monetization, and emergency shareholder financing at the exact same time the actual car-building business was actively consuming cash.
Wow.
That dynamic doesn't make them insolvent today, but it paints a picture of a management team that is absolutely terrified of leaving the balance sheet dependent on flawless execution on the factory floor.
Because they can't afford a single mistake.
They know that a single supply chain hiccup could drain their remaining cash reserves entirely.
So if they're trapping all this cash in the factory floor, what exactly are they building that takes so much capital, and who is actually buying it?
The answer lies in their product mix.
Right, the mix, and specifically something we can call the Valhalla effect.
The Valhalla is their hybrid supercar, and it is a stunning piece of engineering. It serves as this fascinating case study in both the absolute strength of their current brand strategy and its ultimate hard limitation.
Yeah, because they delivered 102 of these Valhalla hybrid supercars in the quarter. Now, because these vehicles are insanely expensive, I mean, we're talking hyper luxury pricing here, those 102 cars single-handedly lifted the total average selling price for the entire Aston Martin brand by 17%.
It's wild. One vehicle contributed massively to the stronger gross margins we were talking about earlier.
And knowing they have 500 more of these expected to be delivered throughout 2026, on the surface, it looks like the Valhalla is the ultimate savior for the company's balance sheet.
It undeniably transforms the immediate economics of the current fiscal year. Those deliveries provide massive, concentrated bursts of high-margin cash.
Okay, but I have a question here. If the Valhalla is selling so incredibly well, and the profit margins per vehicle are that spectacular, why not just build 1,000 more of them?
Right.
Why not just scale up production of the exact car that is making all the money and solve the cash problem permanently?
Because doing so violates the fundamental premise of what the Valhalla actually is.
What do you mean?
In the ultra-luxury automotive industry, a vehicle like this is classified as a special. It is limited production by definition.
Ah.
Scarcity is the actual product. The buyers paying those astronomical prices are paying for the guarantee that their neighbor cannot simply walk into a dealership and buy the exact same car.
Right, so if you mass produce it...
You start mass producing a special to solve a cash crunch, you destroy the exclusivity. And destroying the exclusivity destroys your pricing power, which instantly evaporates the margin. Specials are fantastic financial tools for injecting a quick, powerful burst of revenue and improving a single year's balance sheet. But they are mathematically incapable of permanently replacing the core lineup.
Because the core lineup is the foundation.
Exactly. The core vehicles, the cars they sell day in and day out to keep the factories humming, those still have to generate acceptable, consistent cash returns for the overarching business to actually survive.
And when we pivot away from the hypercars and look at that core reality, the picture is significantly less glamorous.
Very much so.
The core average selling price actually fell by 7%, down to £179,000.
Yeah.
And why did it drop when the brand is supposedly moving up market? Because the company had to step in and offer targeted dealer support to help clear out older, unsold inventory sitting on lots.
And dealer support is a very expensive proposition. In practice, this means the manufacturer is subsidizing financing rates, offering aggressive lease terms, or putting literal cash on the hood to help the dealerships move them out.
That's painful.
It is painful, but it is strictly necessary. Because if core cars sit on a dealership lot for too long, they choke the dealer's financing lines, they weaken the brand's residual values in the used market, and eventually they require even more massive brand-damaging discounts just to get rid of them.
Right.
You have to keep the pipes clear, even if you take a margin hit to do it.
But there is a crucial silver lining hidden in those core numbers, right?
Yes, there is.
The retail sales, meaning cars that were actually registered and sold to a real human customer, those exceeded wholesale deliveries, which are just the cars pushed from the factory to the dealership lots. Retail beat wholesale by more than 50% during this period.
And you cannot overstate how important that specific metric is.
Why is that?
Because it means they are genuinely clearing out the historical backlog. They were not just stuffing the dealer network with unwanted cars to manufacture some fake revenue number for their quarterly earnings report.
Oh, great.
Real customers are taking real deliveries at a faster rate than the factories pushing new cars to the dealers.
So that's good news.
It is. But even with that positive momentum, it highlights a severe underlying tension. The financial success of the quarter was heavily, almost entirely, carried by the limited edition
All
specials.
right, the Valhalla.
Exactly. The core franchise, the everyday Aston Martins, has yet to prove it can sell consistently and profitably without expensive life support and subsidies from the manufacturer.
So because the core cars require that expensive dealer support and the specials are strictly capped by their exclusivity, the actual cash generated falls perilously short of what it takes to run a global automaker.
Yes.
And that operating shortfall forces them to rely on the one thing currently crushing the company, 1.459 billion pounds in debt.
The sheer scale of the leverage here is staggering. I mean, they're carrying an adjusted net leverage ratio of 10.8 times.
Wait, 10.8 times, just to translate that out of financial jargon for a second, does that mean it would essentially take them nearly 11 years of dedicating every single penny of their current operating profit just to pay off the principal balance of the debt?
That is exactly what it means. It is a monumental mountain of leverage. And because interest rates are what they are, management expects to pay roughly 150 million pounds this year, solely in net interest expenses.
Just on interest. That is 150 million pounds that directly competes with funding the factory. It competes with developing the next generation of electric platforms, paying the engineers who actually design the cars.
Exactly.
The debt doesn't care if you build beautiful machines. The lenders expect their cash on time, every time, which is why reports indicate the company is exploring a very aggressive, very specific type of financing solution with lenders like BlackRock's HPS Investment Partners, using a maneuver called a drop-down transaction.
It's the drop down.
And if I am following the mechanics of this right, a drop-down essentially means moving your absolute most valuable assets, so maybe your brand trademarks or your most profitable intellectual property, into a brand new, legally separate subsidiary company.
Correct.
And then you take out a massive new loan backed exclusively by those specific, highly valuable assets. But wait, doesn't that completely pull the rug out from under the old lenders?
Yes.
Didn't the existing creditors lend their money under the strict assumption that those exact premium assets were backing their original loans?
You have zeroed in on exactly why this maneuver is fiercely controversial in the credit markets.
I can imagine.
For the company itself, executing a drop-down is a brilliant, highly aggressive tactic to unlock desperately needed liquidity when traditional borrowing is either entirely unavailable or comes attached to completely toxic interest rates.
Right, because you're using your best stuff.
Right. You are functionally carving out your absolute best collateral, fencing it off, and using it to secure fresh cash.
But the old lenders?
For the existing creditors, it is a nightmare scenario. Suddenly, the most valuable assets that were silently supporting the safety of your old debt have been legally moved out of your reach.
Wow.
A brand new lender has effectively cut the line, grabbed the best collateral, and moved straight to the front of the repayment queue.
So the lenders who kept the company afloat yesterday are suddenly shoved to the back of the line today, looking at a much riskier pool of assets if things go wrong.
It is the brutal reality of distressed corporate finance. When survival is on the line, loyalty to past creditors takes a backseat to securing tomorrow's payroll.
Man.
Now, it is important to note that the company has not confirmed they will definitively execute this exact drop-down structure, only that discussions regarding sophisticated financing solutions are ongoing. But the mere fact that they are exploring a mechanism this aggressive shows you the intense level of pressure they are currently operating under.
Which puts them on a massive time crunch. When you step back and look at the macro-level pressure squeezing them from all sides, they are essentially racing against three separate clocks simultaneously.
Precisely. Let's look at the mechanics of these three ticking clocks.
Okay.
Clock number one is the product clock. This measures raw market desire. Can the newly launched DB12S, the Vantage S, and the Valhalla actually sustain high customer demand over a multi-year cycle, or will the hype fade after the early adopters get theirs?
Right. And then clock number two is the operating clock. Assuming the customer demand remains strong, can the factories physically build the cars efficiently?
Yep.
Can they convert that physical inventory, that trapped carbon fiber and imported leather, into actual cleared cash in the bank fast enough to meet payroll?
And finally, clock number three, the financing clock.
Wow.
This measures the patience and the risk appetite of the capital markets. How long will lenders and shareholders continue to provide expensive lifelines before demanding the company finally becomes self-funding?
And right now, that financing clock is ticking at double speed. especially when you factor in a hidden trap lurking on their balance sheet that has absolutely nothing to do with how many cars they sell US dollar-denominated debt.
Oh yeah, that's a huge factor.
Because they earn the vast majority of their revenue in British pounds and euros, but owe a massive chunk of their debt in US dollars, they are heavily exposed to global currency markets.
It is a brutal mechanism that works entirely against them when the dollar is strong. If the exchange rate moves against the British pound, the reported size of their dollar liabilities suddenly expands in their home currency. A strong dollar means every pound they earn from selling a car suddenly pays off slightly less of that total debt pile.
Ouch.
It creates severe, unpredictable volatility on the balance sheet.
Now, to be perfectly clear on how this works, this is a non-cash accounting charge, right? It's not like they are writing a physical check for the currency difference that day.
Correct. It is not an immediate cash drain out of the corporate checking account, but it radically alters their reported leverage ratios and the financial optics presented to investors and future lenders.
Got it.
It demonstrates just how painfully sensitive their entire capital structure is. Even if the actual car manufacturing business is executing perfectly and having a record sales month, a sudden macro swing in the currency markets can make their overall financial position look significantly worse, literally overnight.
So when you look at all these vulnerabilities, the debt, the currency exposure, the lumpy supply chain, it forces a really obvious question. Why doesn't a company like Porsche or Lamborghini constantly face these existential financial crises? They sell hyper-expensive cars, too.
The answer comes down to one word: scale. What we are looking at with Aston Martin is the profound burden of independence.
Independence?
Yes, Porsche and Lamborghini belong to the massive Volkswagen Group empire. Aston Martin is out there trying to survive entirely on its own.
And the math on that independence is punishing. If you are Porsche and you need to develop a brand new state-of-the-art software infotainment system, or you need to run 100 destructive crash tests for a new platform, or engineer complex emissions compliance for new European regulations, you spend the money, but then you spread that massive development cost across millions and millions of vehicles globally within the VW network.
Exactly. Aston Martin has to fund those exact same non-negotiable regulatory and technological requirements. They have to pass the same crash tests and meet the same emissions standards.
But they don't have millions of cars.
No, they have to amortize that massive fixed cost across just a few thousand cars a year. Exclusivity gives them immense pricing power on a per-vehicle basis, but it severely limits the volume they have available to absorb those fixed costs.
That makes sense.
If a crash test program costs £50 million, dividing that by 5,000, Aston Martin's means adding £10,000 to the cost of every single car just to cover the testing. For a massive auto group, that same test costs a few pennies per car.
So they are paying full premium price for all the necessary R&D, but they are only splitting the bill 5,000 ways instead of 5 million ways.
Which also means global macroeconomic shocks hit independent players disproportionately harder.
Yeah.
If the United States unexpectedly changes its tariff arrangements on luxury imports, it wildly complicates their shipment timing and working capital. If China's luxury vehicle market suddenly slows down, or regional taxes on ultra-luxury vehicles jump up, a massive auto group absorbs that regional volatility across its other brands and markets.
But Aston Martin cannot.
Exactly. A shipping delay of just a few hundred high-value cars in one key market can entirely derail their quarterly earnings and trigger a liquidity crisis.
So we have walked through the mechanics of the crisis. We see the sheer weight of the debt, the uneven sales cycles forcing dealer support, the aggressive drop-down financing maneuvers, and the structural nightmare of being an independent automaker trying to fund modern R&D.
It's a lot.
It really is. Now we have to evaluate the ultimate trajectory of this company. Where does this actually end for them? Let's map out the bull case versus the bear case. I'll make the argument for the optimist.
Go for it. Walk through the upside scenario.
All right, if you look closely at management's own long-term projections, they are guiding that profit margins will hit the high 30s by 2026 as the newer, higher-priced models fully replace the old inventory.
Okay.
They project that their massive cash-draining capital investments will finally peak and drop down to roughly £300 million a year. And crucially, they expect the free cash outflow to improve drastically from the massive £410 million crater we saw modeled for previous cycles. Right.
So, if you believe that the internal guidance is accurate and the new cars will command those prices without dealer subsidies, then securing this BlackRock financing right now before the Valhalla deliveries really ramp up is just incredibly smart, proactive management.
It could be.
They are locking in a financial safety net while they have momentum, securing runway before a potential macro crisis hits, rather than waiting until the bank account is empty and issuing a desperate cry for help.
That is the credible mathematical bull case. In corporate finance, raising capital before you absolutely have to always yields vastly better terms than waiting until your suppliers and customers are openly questioning if you'll survive the week.
Right.
But we have to balance that by looking at the bear case, which is arguably much more insidious than a traditional collapse.
Why insidious?
Because the bear case for this company isn't a sudden, fiery bankruptcy where they close the factory doors tomorrow. It is a slow, grinding bleed into becoming a zombie company.
A zombie company. Yes. In this negative scenario, the Valhalla margins provide just a temporary sugar high to the balance sheet. The pricing on the core models remains structurally weak, requiring permanent dealer support. That massive debt pile and the £150 million in annual interest continues to eat all the cash that should be going into R&D for the electric transition.
Wow.
External supply chain shocks keep randomly interrupting their delivery schedules, keeping cash trapped in inventory.
And every time they take on a new, more expensive loan, like this potential drop-down transaction that pushes old lenders away, the mathematical hurdle for the next turnaround target gets exponentially higher.
Precisely. In the zombie scenario, they survive technically. The brand lives on.
Yeah.
But they only survive through constant, incredibly expensive cash injections from aggressive institutional lenders.
Which just drains them.
Those lenders slowly siphon away all of the company's future economics through high interest rates and fees. It wouldn't be a failure of the product. People would still inherently want to buy the beautiful cars.
Right.
It would be a total structural failure to convert that undeniable product desirability into true financial independence.
When you step back from all the leverage ratios and the drop-down mechanics, the real tragedy of Aston Martin isn't a lack of desirability. It's a brutal, unforgiving mismatch of timing.
Mismatch of timing, exactly.
Customer demand arrives unevenly. It's lumpy. You sell a few core cars here, a batch of hybrid supercars there. Maybe a shipment gets delayed at a port for a week.
Yeah.
But the factory wages, the global supplier bills, and those massive heavy interest payments to the lenders, those obligations arrive exactly on schedule every single time, regardless of how many cars rolled off the line that day.
Which forces us to ask a much larger question about the automotive industry itself. A new financing package from a massive Wall Street firm can buy a legacy company time, but it absolutely cannot buy proof of a viable business model.
No, it can't.
The true proof of survival only arrives when a manufacturing company can fully fund its next generation of products using the cash generated organically by its current ones.
Right.
Until we see that happen without emergency loans or asset sales, we have to wonder, are independent, luxury heritage brands mathematically destined to be nothing more than beautiful financial illusions?
Subscribe to the Unlayered Global now, because this channel does not just explain the headline, it reveals the hidden system underneath it.